Investing in unlisted stock is drawing a lot of attention. We thought we'll create a video which clearly spells the pros and cons of unlisted stock investing. So let us start with the pros. First of all, it has a potential of delivering a very high return. Now, ASIL invested in Facebook in 2005. The investment was worth $12.7 million. The same investment, when Facebook went into IPO, was valued at $6.6 billion. So it has a potential to deliver high return, first. The second, now India do not have a large history of unlisted stock investing. So I'll use the example of US data points. Now, if you look at S&P 500 over the last 20 years, it has delivered a CAGR return of 5.91%. If you go down to the small cap, the return of Russell 2000 is 6.69% over the last 20 years. Now, if you look at the private equity Cambridge Associates Index, which measures the invested and unlisted equities, the return is at 10.48% CAGR over the last 20 years, which is almost close to double the S&P 500. Third, investors get an early access to some of the innovative companies. For example, Draper Fisher Jurvetson got access to investing in SpaceX, which is Elon Musk's company, which has revolutionized space travel and space research. He has access to such kind of investment at an early stage. Fourth, investing at an early stage, and if they get a sizable exposure in the company, they give control or influence over the company. Now, to make my point, Slack Technology, actually ASIL and SoftBank both invested in that company, and they were instrumental in guiding the company to not only grow in scale but go to an IPO stage. When Slack Technology went for an IPO, it got valued at almost $23 billion. The unlisted stock, by virtue of being not trading in the listed market, is subjected to less market volatility because the price discovery is not happening on a real-time basis. So hence, it has less market volatility. Let us understand what's the cons of investing in unlisted equity. And high risk of failure. Okay. Now, many times, it depends upon at which stage of unlisted equity investment you are investing in. If you are investing at a very early stage, an angel or a VC level, where the business model is not established, it has a greater risk of failure. So, for example, in this space, you have companies like SBI Fund Management also, Care Health Insurance. So these companies, the business model has been established. So there is little risk on the business model and hence it is fairly stable. Two, most of these unlisted companies have very limited information and you have to take transparency with a little bit of pinch of salt. And there is, since it's not listed, it is not compulsory for them to disclose everything on a quarterly basis as per the listing agreement does. Hence, you will have limited information on this company. Third and very important point is that given the fact this is not actively traded in the market, it is illiquid. Okay, and illiquidity in itself can be a risk that one has to factor upon. Fourth, this valuation remains a challenge because if it's unlisted, the valuation will be should be lower than the listed counterpart or peer. The reason why? Because the investor would like to factor the risk of liquidity in it, and hence, given that scenario, the unlisted stock should be relatively available at a lower valuation or market cap compared to the listed space. Fifth, an average investor has very limited access to investing in unlisted. Either the ticket size are very high, it is not generally available at a very low ticket volume. This is just a basic pros and cons of investing in unlisted equity. But if you want to delve a little bit more deeper, We have a lovely blog which compares between listed and unlisted stocks investment, which compares between the different category of investors such as angel investing, VC investing, and private equity investing. You can find the link below in this video. If you wish to discuss more about unlisted stock investing or any of your investment, feel free to call us on this number below or write to us on the comment.